Recently, the news of an economic recovery has been making the rounds in the Pakistani financial community. And this very news is bringing in hot money into the Pakistani bond market. But why should you care? And if money is coming in, then obviously it must be a good thing for the economy. Well, sort of and sort of not. But first, let's talk about the bond market and why signals of an economic recovery might just lead to Pakistan's next financial crisis. In its simplest terms, the bond market is a market to buy and sell bonds, which in the case of Pakistani market almost invariably means government bonds. Unlike stocks, which represent a share in the ownership of the company, a bond is a promise to pay, essentially a loan, with a fixed repayment date and interest rate. Now, in general, the longer the time to maturity of a bond, maturity referring to when the full repayment is due, the higher interest rates investors will demand, at least under normal circumstances. The reason being, the longer the time to repayment, the more things can go wrong, and the more likely it is that the loan bond will not be repaid. So why all this jargon, and what does it have to do with Pakistan's next economic crisis? The yield curve is a graph of the average yield to maturity of bonds against the time to maturity. Under normal circumstances, it should be an upward sloping line. As time to maturity increases, so does yield to maturity of the bonds. When the slope is curving upwards normally, there really is not much to say about the curve. However, an inverted yield curve refers to the phenomena, usually relatively brief and anomalous, of when short-term interest rates are higher than long-term interest rates. Now, this is very important. This signal is generally taken to mean something very important in most economies. For example, for the US economy, it may signal the start of a recession, but for Pakistan, this may just show an end to recession and the road to recovery. Pakistan has had an inverted yield curve twice in recent history since 2007, once through April 9, 2009 till October 3, 2009, and then again through August 19, 2019 to date. And both periods of negative yields have one thing in common. They both occurred shortly before or after the end of a financial year of negative nominal growth in the gross domestic product, the total size of the economy. Pakistan's recessions typically tend to be the product of a fundamentally insane policy decision that the country's leadership has been repeating since 1949, a belief that somehow there is a magic number for the rupee's exchange rate against the US dollar that must never change. This, quite obviously, is not something that a country like Pakistan, with its perennial trade deficits and lack of significant foreign investment flows, can keep up. As a result, periodically, the government's attempts to control the price of the rupee fails miserably and it comes crashing down. But with a crash, that frequently brings down with it the whole economy. For more details on how all this works, make sure to check out the detailed piece by Prophet about the bond market. Link to the story is in the description. Let us know in the comments below what you think. If you haven't subscribed to Prophet, you can follow us on Facebook, YouTube, Twitter, and Instagram.